I'm back, baby.
Welcome back to the Canadian Portfolio Manager Podcast, where we help you better understand and manage your ETF portfolio. I'm your host, Justin Bender, and today we'll be discussing a topic that's still foreign to many investors: withholding taxes on your foreign ETF distributions. I've been interested in foreign withholding taxes since reading DFA's article on the topic back in 2012. So inspired, I spent countless nights and weekends poring over the annual financial statements of my favorite ETFs. I became determined to create a methodology for estimating this mysterious and usually hidden tax drag. Okay, so my wife might call my determination more of an obsession. Either way, it was well worth the effort. In 2013, we published the first edition of our foreign withholding tax white paper, which Dan Bortolotti and I will be updating soon for 2020.
Yeah, I look forward to reading it.
Shortly after publication, it looks like ETF providers began to take notice. Many of them started creating more tax-efficient fund structures aimed at reducing the withholding tax drag on their existing products. Before we dive in too deep, let's review what I'm talking about here. Many countries impose a tax on dividends paid to foreign investors. For example, the U.S. government levies a 15% tax on dividends paid to Canadians. Because these taxes are sometimes withheld before dividends are paid in cash, they often go unnoticed. But their impact can be far greater than that of management fees, which get much more attention.
You're right. We're getting screwed. There must be something I can do about this. Wait. Yes, I think I know just the thing.
The amount of withholding tax payable depends on two important factors. The first is the structure of the ETF that holds the stocks. The second is the type of account used to hold the ETF. Let's talk about the ETF structure first. Canadian ETF investors can get exposure to U.S., international, and emerging market stocks in three ways. 1. Through a U.S.-listed ETF that holds the foreign stocks. 2. Through a Canadian-listed ETF that holds a U.S.-listed ETF that holds the foreign stocks. And 3. Through a Canadian-listed ETF that holds the foreign stocks directly. In all three cases, investors are potentially subject to whatever withholding taxes are levied by the countries where the stocks are domiciled, whether that's in the U.S. or overseas. This is referred to as Level 1 or First Level Withholding Tax. Investors are also subject to Level 2 or Second Level Withholding Tax when international or emerging market stocks are held indirectly via a Canadian-listed ETF that holds a U.S.-listed ETF. Specifically, there's an additional 15% U.S. tax on the foreign dividends before the U.S.-listed ETF pays the net dividends to Canada. To visualize how this double layer of withholding tax works, think of your Canadian investment portfolio as a movie theater seat, with a U.S. concession stand between the theater entrance and your seat. The cost of your movie ticket is like your Level 1 withholding tax. The additional cost of your popcorn, soft drink, and bag of Twizzlers is your Level 2 tax. Fortunately, as most frugal moviegoers know, you can avoid the extra expenses by sneaking in your own snacks. Similarly, but entirely lawfully, there are a few clever ways to sidestep the Level 2 withholding taxes on your foreign dividends. And in some cases, you may be able to avoid Level 1 taxes too. The second key factor I mentioned earlier on is the type of account in which you're holding the ETF. Different account types, such as RSPs, TFSAs, and taxable accounts, are vulnerable to foreign withholding taxes in different ways. Let me give you some quick examples. When U.S.-listed ETFs are held directly in an RSP or other registered retirement account, such as a RIF or locked-in RSP, investors are exempt from withholding tax from the U.S., but not from overseas countries. This exemption unfortunately does not apply to TFSAs, RESPs, or RDSPs. If you hold foreign equity ETFs in a taxable account, you'll receive an annual T3 or T5 slip indicating the amount of foreign tax paid. This amount can generally be recovered by claiming the foreign tax credit on your return. However, if your international or emerging markets equity ETF is subject to both first and second level withholding taxes in a taxable account, only the second layer of U.S. withholding taxes is recoverable. And, since no tax slips are issued for dividends received in a registered account, any foreign withholding taxes incurred in an RSP, TFSA, RESP, or RDSP are not recoverable. Bottom line, if you like 2 layers of butter on your popcorn, but you aren't a fan of 2 layers of withholding taxes on your foreign dividends, stay tuned. Now that we've set the stage, we're going to walk you through some of those clever steps you might be able to take to mitigate your tax drag without running afoul on CRA tax codes. We'll start by breaking up the withholding tax discussion into each of the 3 main foreign equity asset classes: U.S., international, and emerging markets equities. We'll then talk about which ETF structures are the most tax efficient for each account type, as well as when it might make sense to skip the rules of thumb. Later on, we'll also discuss withholding taxes on global equity, global fixed income, and asset allocation ETFs. So let's start with U.S. equity ETFs. As mentioned earlier, there are 3 ETF structures to choose from for this asset class. First, a U.S.-listed ETF that holds U.S. stocks. Second, a Canadian-listed ETF that holds a U.S.-listed ETF that holds U.S. stocks. And third, a Canadian-listed ETF that holds U.S. stocks directly. In an RSP or RIF account, the first structure is the winning one from a withholding tax perspective, which is a U.S.-listed ETF that holds U.S. stocks. Holding a U.S.-based U.S. equity ETF in your RSP or RIF exempts all dividends from the 15% U.S. withholding tax. Based on the current U.S. equity dividend yield of about 1.8%, this should save you around 0.27% per year. Some popular examples of this structure include the Vanguard Total Stock Market ETF, VTI, and the iShares Core S&P Total U.S. Stock Market ETF, ITOT. Both funds also have lower expense ratios than their Canadian-based counterparts. But as usual, there's a catch to be aware of. To purchase VTI or ITOT in your RSP, you'll first need to convert your loonies to U.S. dollars. And even if you use Norbert's Gambit to reduce the cost of buying U.S. dollars, there's still going to be some transaction costs. As an example, suppose we're converting 20,000 Canadian dollars to US dollars. At most brokerages, you'll pay 2 $10 commissions to buy and sell my preferred ETFs for the Gambit, which are DLR and DLR.U. There also will be a hidden trading cost of the bid-ask spreads. If properly executed, the total percentage cost will be roughly 0.27% on a $20,000 Gambit. Given an annual withholding tax savings of 0.27%, you should be able to offset this cost in about a year. But what if you're converting a smaller amount, such as $2,000 Canadian? The overall percentage cost of the conversion will be around 1.31%, which will take nearly 5 years to offset with your annual withholding tax savings of 0.27%. And remember, you'll be hit again with more transaction costs if and when you eventually convert your US dollars back to Canadian dollars. The takeaway? If you have a smallish portfolio, you might want to stick with Canadian-listed U.S. equity ETFs for now. Next, let's look at holding U.S. equity ETFs in a TFSA, RDSP, or RESP, where there's nothing you can do about the withholding tax drag. U.S.-listed U.S. equity ETFs receive no preferential tax treatment in these account types, so they're effectively the same as the other 2 ETF structures. For this reason, we'd recommend holding a Canadian-listed ETF that holds a U.S.-listed ETF that holds U.S. stocks, or a Canadian-listed ETF that holds U.S. stocks directly. The Vanguard U.S. Total Market Index ETF, VUN, is one such fund with a U.S. wrap structure. It simply holds the U.S.-listed ETF, VTI. Another example would be the iShares Core S&P U.S. Total Market Index ETF, XUU, which holds ITOT. The BMO S&P 500 Index ETF, ZSP, is an example of a fund that holds the underlying U.S. stocks directly. Its structure is very similar to that of VUN or XUU from a withholding tax perspective. If you already hold U.S. dollars in one of these account types, you could consider purchasing a U.S.-listed U.S. equity ETF, as it would reduce your product costs slightly. Just keep in mind that the foreign dividends will still be subject to the 15% U.S. withholding tax. Next up, let's talk about your taxable accounts. Again, U.S. withholding tax also applies here no matter which ETF structure you choose. You can generally claim a foreign tax credit to offset this tax drag, but you'll still pay income tax on the full dividend. As mentioned earlier, a slightly lower product cost is the main benefit of holding U.S.-listed U.S. equity ETFs like VTI and ITOT. But since it would take many years for these product cost savings to offset the currency conversion costs to buy U.S. dollars, we'd still recommend holding Canadian-listed U.S. equity ETFs like VUN or XUU in your taxable accounts. Again, there are a couple notable exceptions. First, if you already have US dollars available in your taxable account, you could consider purchasing US-listed ETFs. Keep in mind, there may be additional CRA reporting requirements, such as completing a T1135 form each year. If you want to avoid the T1135 reporting, you could consider purchasing a US dollar version of a Canadian-listed US equity ETF like XUU.U. Either way, you'd be required to track the cost base of your US dollar-denominated ETF in Canadian dollars, which can be a bit of a pain. And second, if you're a Canadian-US dual citizen, you can potentially reduce your passive foreign investment company or PFIC reporting costs by holding US-listed instead of Canadian-listed ETFs in your taxable accounts. Next, let's look at tax-efficient international equity ETFs for your accounts. But before I offer my take, let's hear from Kevin Prince, Managing Director and Head of ETF and Managed Accounts at BMO. Kevin will discuss some of BMO's tax-efficient international and emerging markets equity ETFs, as well as why he believes bigger is usually better when it comes to choosing an ETF provider. In February 2014, BMO launched the MSCI EAFE Index ETF, ZEA. At the time, ZEA held its underlying stocks directly, which made it the most tax-efficient ETF on the block. The most interesting part about ZEA's innovative design was that BMO didn't even set out to create a more tax-efficient fund. It just happened to work out that way. Here's Kevin's take on it.
Kevin Prince, BMO Exchange-Traded Funds, discussing withholding tax and international investing. I appreciate the opportunity to participate in this podcast that focuses on efficiency of international investing through Canadian ETFs. At BMO ETFs, we have some of the largest international and emerging market ETFs, engineered specifically for Canadians who want to invest globally. This includes the BMO MSCI EAFE and the BMO MSCI Emerging Markets. These ETFs became some of the largest due to their low cost and efficient access to world markets for both individual investors and institutional investors. When we launched these ETFs, we introduced them at a lower cost than the US providers operating in Canada. We brought out choice in currency, hedged and unhedged, which also has the added benefit of saving on the currency conversion costs to access these global markets. As a Canadian-based ETF provider focusing on Canadian investors, it was only natural for us to hold the underlying stocks in trust here in Canada, which is key for us to provide the withholding tax advantages. Funny story, at launch, we didn't know of the withholding tax advantage that we had. We were just building ETFs for Canadians and doing what was natural for us, and that was to hold the stocks in Canada. It was actually the work of Justin Bender and Dan Borolotti that pointed out to us that there were withholding tax advantages to hold the underlying here in Canada. Finally, let me also give you a tip to look beyond the consideration of the direct cost and withholding tax. Take a look at the scale of the ETF provider and their approach to acquiring the underlying stocks. This can help mitigate the indirect costs that are seen in the trading expense ratio, commonly known as TER. For example, when you look at international investing at launch of our ETF, the cost, or the TER, was higher than it was today. This is reflective that we were accepting third-party ETFs in the creation process and then traded them out to buy the underlying stocks. Now, given the size of our ETFs, we get the underlying stocks directly in the creation process. This has made our trading more efficient and further reduced the trading costs, or TER, to about 5 basis points, which is very efficient when you look at not only the trading costs, but the stamp duty in some markets like the UK. You'll see a higher TER with ETFs that are converting to direct holdings or ones that may not have the scale to transact directly in the underlying markets. Just another consideration when you look at investing internationally.
Thanks, Kevin, for your comments. Now on to our perspective. When choosing between the 3 international equity ETF structures to hold in your RSP or RIF, you can immediately scratch one of them off your list. That's a Canadian-listed ETF that holds a US-listed ETF that holds international stocks. This US wrap structure was originally how companies like Vanguard Canada and BlackRock Canada structured their international equity ETFs, and it's how they still structure their US and emerging markets equity ETFs. When this fund type is held in an RSP or RIF, foreign dividends are first paid to the US-based fund, generating a layer of withholding tax in the process. From there, the net dividends are then paid from the US to the Canadian-based fund, creating another layer of withholding tax. The end result is a tax drag of around 0.7% per year. This fund structure can still be seen, although probably best avoided, in ETFs like the Vanguard FTSE Developed All-Cap ex-US Index ETF, VDU. The remaining two fund structures avoid the second layer of US withholding tax in RSPs and RIFs, but for different reasons. A Canadian-listed ETF that holds international stocks directly allows the foreign dividends to bypass the US on their way to Canada. In doing so, the second layer of withholding tax is avoided, although the first layer still applies. The result is a tax drag of around 0.3% per year. Examples of funds with this structure include the iShares Core MSCI EAFE IMI Index ETF, XEF, the Vanguard FTSE Developed All-Cap ex-North America Index ETF, VIU, and the BMO MSCI EAFE Index ETF, ZEM. Next up, there's the US-listed ETF that holds international stocks. This structure also avoids the additional tax drag when held in an RSP or RIF, where it is exempt from the US withholding tax. An example is the iShares Core MSCI EAFE ETF, IEFA, which offers two additional benefits. First, IEFA has lower product fees at an annual cost of 0.07%, compared to XEF's cost of 0.22%. Second, IEFA is expected to have a lower tracking error relative to its index. It's currently around 26 times bigger than XEF and can arguably track its index more closely with this level of scale. In TFSA, RDSP, and RESP accounts, the preferred fund structure is the third kind. That is, a Canadian-listed ETF that holds international stocks directly. This structure results in only one layer of withholding taxes, while the others have two layers of tax drag. So if you're holding international equity ETFs in your TFSA, we'd suggest opting for XEF, VIU, or ZEM. We prefer the same for taxable accounts. When you hold a Canadian-listed ETF that holds international stocks directly, only one layer of withholding taxes will apply, and even that one layer may be recoverable. Compare that to the other two structures, which are US-listed ETFs like IEFA that hold international stocks, or Canadian-listed ETFs like VDU that hold a US-listed ETF that hold international stocks. Both of these will be subject to two layers of withholding tax, and only the second layer of US withholding tax may be recoverable. So again, our vote for taxable account holdings goes to ETFs such as XEF, VIU, or ZEM. Now I know this is quite a lot to take in. If you've been following it all closely, maybe even taking notes, you may have identified a critical common thread. If you don't feel like messing around with Norbert's Gambit to convert your Canadian dollars to US dollars, you may want to just hold XEF, VIU, or ZEM in any account type, as they are all relatively tax-efficient choices across all accounts. Now before we dive into emerging markets, let's hear from Stephen Leong, who leads product and capital markets for BlackRock's ETF business in Canada. Stephen will discuss XEF's transition away from the traditional US wrap structure. He'll also provide commentary on why BlackRock still uses the US wrap structure on some of their other asset classes, like US and emerging markets equities.
Justin, thanks so much for having me on your podcast today. I'm really excited to spend a couple of minutes talking about one of my favorite ETFs. It's called the iShares Core MSCI EAFE IMI Index ETF, or more commonly known as XEF, which is the symbol that it trades under. XEF has over $3.5 billion in assets under management, and it's the largest ETF in Canada that invests exclusively outside of North America. It has exposure to over 20 different developed markets around the world, but it excludes Canada and the US. So it's a very powerful tool for diversifying stock portfolios. It tracks what MSCI calls an investable market index, which means it includes large cap, mid cap, and small cap securities. The fund itself holds over 2,600 individual positions. We ourselves at BlackRock, we're actually a big user of this ETF. It's held both by our very popular XAW, which is a global stock excluding Canada ETF, and also by our newer core asset allocation portfolios like XPAL and XGROW. That being said, About 80% of XEF's assets under management is held directly by investors. Thinking about the popularity of this ETF a little bit, a huge part of XEF's success really comes down to the fact that it actually invests directly in all of those different international markets, despite the fact that it offers a very low MER of just 22 basis points. The first generation of international equity ETFs in Canada mostly gained exposure indirectly by investing in another US-listed ETF. This is commonly called a US wrap structure or a fund-to-fund. Now, this is a pretty efficient approach for making the exposure available in Canada, but it has one really important drawback, which is around withholding tax, particularly if you're a non-taxable account. Because the Canadian ETF, in this case, holds a US ETF, it faces US withholding tax on income received from that ETF. Now, one of the reasons that US wrap structure came into existence is because of some of the things that you have to balance as an ETF manufacturer. As a manufacturer, you have to balance design decisions around management fees, tracking error, expected bid-ask spreads, as well as tax or withholding tax. XEF itself actually started its life using a US wrap structure, and it was able to deliver on low fees, tight tracking, low bid-ask spreads through that structure. But it did come at the cost of maximizing tax efficiency. However, in early 2014, BlackRock created what we call our Core series, low-cost, broadly diversified, widely applicable ETFs, really designed with the long-term investor in mind. XEF became part of that Core family, and shortly after, although only after it had grown large enough to maintain low tracking error, XEF was transitioned from a US wrap structure to holding equities directly. This eliminated the friction of US withholding. Now, one other thing we had to keep in mind in making that transition was to really keep a close eye on liquidity. The bid-ask spread is a pretty important consideration when you're evaluating the total cost of using an ETF, and a significant increase in the portfolio complexity by owning all of those other countries directly had the potential to lead to wider spreads. So one of the things we did was, as an additional enhancement, we developed a special subscription redemption technique that actually allows authorized dealers in Canada to deliver a US iShares ETF into XEF. This helps to improve XEF's liquidity by creating a conduit to a really liquid US iShares ETF. If you visit our website, you'll sometimes notice that XEF still holds a small position in a US iShares fund. However, because the position is small, our portfolio managers manage around the dividends and therefore mitigate the effect of US withholding. Sometimes we'll be asked, why don't we move every single one of our products to a physical structure and just eliminate US wraps altogether? Here, I think there's a few important points to make. First, the US wrap structure is actually pretty efficient for US equities and most US bond exposure, so there's no reason to change there. Secondly, the transition itself is important. So for an ETF to transition from a US wrap to direct holdings, it's going to end up realizing any embedded capital gains it has on that US ETF. This can often be prohibitive. The change happened to XEF pretty early on in its life, so it was manageable, but that won't be the case all the time. Lastly, though, I think it's important to come back to the need to optimize around the fee that the product charges, the tracking error the product is expected to deliver, and the bid-ask spread that investors will face, as well as withholding efficiency. We're always reevaluating all the products in our lineup to maximize their efficiency, but in some cases, like broad-based emerging markets, the optimal balance of all of those factors is still a US wrap structure.
As Stephen mentioned, BlackRock Canada's emerging markets equity ETFs do not hold the emerging market stocks directly. Neither does Vanguard Canada's. So the main ETF providers have all taken action to improve the tax efficiency in their international equity ETFs. But so far, only BMO has taken the leap into creating a more tax-efficient emerging markets equity ETF. Even so, in RSPs and RIFs, the rules work the same for emerging markets as they do for international equity ETFs. The most tax-efficient structure would be either a US-listed ETF that holds emerging market stocks, or a Canadian-listed ETF that holds the emerging market stocks directly. In both cases, you avoid the second layer of US withholding tax, so your overall tax drag is around 0.3% per year. Examples of US-listed ETFs include the iShares Core MSCI Emerging Markets ETF, IEMG, and the Vanguard FTSE Emerging Markets ETF, VWO. Both of these invest in large, mid, and small-cap emerging market stocks. The BMO MSCI Emerging Markets Index ETF, Zeti M, is an example of a Canadian-listed ETF that holds the emerging market stocks directly. Zeti M only invests in large and mid-cap emerging market stocks, so it's not as diversified as IEMG or VWO. If you choose to hold a Canadian-listed ETF that holds a US-listed ETF that holds the emerging market stocks, there's the iShares Core MSCI Emerging Markets IMI Index ETF XEC, which just holds IEMG, or the Vanguard FTSE Emerging Markets All-Cap Index ETF VEE, which holds VWO. With either, your withholding tax drag will increase from 0.3% per year to around 0.7% annually. In TFSA, RDSP, and RESP accounts, the most tax-efficient fund structure is a Canadian-listed ETF like Zeti M, which holds the emerging market stocks directly. This will result in only one layer of foreign withholding taxes, while the other structures will have 2 layers of tax drag. However, as we'll learn in our upcoming ETF Kombat, there are other indirect costs to this structure that investors should consider. I'll get into the details soon, but for now I'll just say that Zeti M's structure is arguably the most tax efficient from a withholding tax perspective, but that doesn't mean it's the most optimal structure when all costs are considered. For this reason, we still recommend holding XEC or VEE in these account types. Last up, in taxable accounts, only one layer of withholding taxes will apply and may be recoverable if you hold a Canadian-listed ETF that holds the emerging market stocks directly, like Zeti M does. US-listed ETFs like IEMG or VWO that hold emerging market stocks, or Canadian-listed ETFs like XEC or VEE that hold a US-listed ETF that holds emerging market stocks, will both be subject to 2 layers of withholding tax, and only the second layer of US withholding tax may be recoverable. Even so, we'd still recommend holding XEC or VEE in your taxable accounts, at least for the time being. Okay, we've now covered the 3 kinds of fund structures for US, international, and emerging market stock ETFs across a range of investment account types available. In part 2 of the show, we'll take on global equity, global fixed income, and asset allocation ETFs, as I promised earlier. But first, this seems like a good time to take a break and segue into our
ETF Kombat.
where we pit 2 ETFs against one another to test their might. In today's showdown, the BMO MSCI Emerging Markets Index ETF, Zeti M, will face off against the iShares Core MSCI Emerging Markets IMI Index ETF, XEC. Although both ETFs have similar costs and provide diversified exposure to emerging stock markets, there can be only one winner in this.
ETF Kombat. Round 1. Fight!
Zeti M and XEC both follow MSCI Emerging Markets indices. However, Zeti M includes only large and mid-cap stocks, while XEC adds a healthy dose of small-cap stocks to its portfolio. As XEC provides investors with more complete exposure to emerging markets companies of all sizes, it'll dish out the beating in this round.
XEC wins. Round 2. Fight!
Zeti M attempts to hold the majority of its underlying stocks directly, while XEC has chosen to simply hold its US-listed counterpart, IEMG. All else equal, holding the underlying stocks directly, like Zeti M has chosen to do, is expected to result in lower, unrecoverable foreign withholding taxes for investors across all account types, relative to using a US-based wrap structure like XEC does. Although there's additional cost to holding the underlying stocks directly, we'll award this round to Zeti M anyway, just for BMO's creativity.
Zeti M wins. How do you like them apples? Round 3. Fight!
Trading expenses are expected to be higher when purchasing hundreds of stocks directly, rather than buying a single US-based ETF. This additional cost shows up in the trading expense ratios of the ETFs, which have been around 0.07% on average for Zeti M, but only 0.03% for XEC. Tightly tracking the index is also going to be easier for XEC. By holding IEMG, XEC can piggyback on the economies of scale enjoyed by this larger, US-based ETF, which is more than 60 times larger than Zeti M. Although both XEC and Zeti M exclude over 500 companies due to their sampling strategies, XEC generally excludes smaller companies with less weight in the index and therefore less impact on performance. Most of Zeti M's exclusions are mid-sized companies with a higher weight in the index and therefore a greater impact on performance. The success or failure of each fund's sampling strategies will show up in the performance differences between the ETF and its underlying index. If we ignore management expense ratios, which are similar for both XEC and Zeti M, we find that both funds have underperformed their respective indices by around 0.9% over the 5 calendar years ending December 31st, 2018. This would indicate that the total cost of XEC's US-based wrap structure is still on par with Zeti M's more tax-efficient structure, due to better sampling and lower trading costs.
Finish it.
With better diversification, lower trading costs, and a more successful sampling strategy, XEC emerges as champion. However, if Zeti M's assets continue to grow, and if it adds small-cap companies to its fund, BMO may be able to shoulder out its rival at some point in the future.
XEC wins. Frugality.
Now that we've covered the foreign withholding tax basics for US, international, and emerging markets ETFs, let's check out Global Equity ex-Canada ETFs. Remember, a Global Equity ETF is just a roll-up of all the 3 foreign equity asset classes into a single global fund. 2 popular examples are the iShares Core MSCI All-Country World ex-Canada Index ETF XAW and the Vanguard FTSE Global All-Cap ex-Canada Index ETF VXE. Until recently, Vanguard Canada used a tax-inefficient wrap structure in VXE. The fund gained its exposure to companies in Europe and the Asia-Pacific by holding 2 US-listed international equity ETFs, the Vanguard FTSE Europe ETF, VGK, and the Vanguard FTSE Pacific ETF, VPL. This structure added an extra layer of foreign withholding tax on the international equity portion of the fund. But that was then. Now, Scott Johnston from Vanguard Investments Canada is here to talk about some recent improvements Vanguard Canada has made to VXC.
Hi, it's Scott Johnston here, Head of Product for Vanguard Investments Canada. I'm here to talk about some recent changes to our Vanguard FTSE Global All Cap X Canada ETF with the ticker VXC. This product is intended to give simple exposure to the global non-Canadian equity market, so large, mid and small cap equity, as well as developed and emerging markets in a single ticket. We've recently made 2 changes to the product to make it even better for clients. Firstly, we changed how it gets its global equity exposure. To keep costs low, this ETF works by buying or wrapping other ETFs for the different segments of the global market, US, Europe, Asia Pacific, and emerging markets. For Europe and Asia Pacific, it used to wrap Vanguard's US-based ETFs. We've recently changed this to wrapping our Canadian-based Develop All Cap X North America ETF with the ticker VIU, which covers all of Europe and Asia Pacific. This improves withholding tax efficiency of VXC by an estimated 0.14% or 14 basis points by having that exposure come directly through a Canadian product rather than via a US product. And this makes it one of the more tax efficient products in this section now. The second change we've made is to lower the management fee of the product from 25 basis points to 20 basis points. Lowering the cost of investing over time, it's just inherently part of Vanguard's DNA. When we first offered ETFs in Canada, our weighted average management expense ratio, or MER, was already low at 27 basis points. Today it's even lower at just 16 basis points. Taking into account the total cost of ownership, which covers MER and withholding tax that I talked about, as well as expected spreads, for a normal 3-year holding period, this makes VXC, by our calculations, the lowest all-in cost ETF in the category. In addition to cost, one standout feature of VXC is breadth. This one product gives access to over 10,000 underlying holdings, more than the comparable Canadian ETFs, which is highly relevant for a global equity exposure. To summarise, we're very happy to be able to improve the price and tax efficiency of VXC, and think this is a great option for anyone looking for a simple, single ticket to get their global non-Canada equity exposure for their portfolio.
After this recent change, the foreign withholding tax implications for both VXC and XAW are now the same as for their individual underlying ETFs, with a noteworthy exception. If you hold VXE or XAW in an RSP or RIF, and the fund holds an underlying U.S.-listed U.S. equity ETF or a U.S.-listed emerging markets equity ETF, you do not avoid the 15% withholding tax on U.S. dividends. Because of the additional tax drag in RSPs and RIFs, some investors prefer to hold a U.S.-listed global equity ETF instead, like the Vanguard Total World Stock ETF, VT. This ETF has similar exposure to XAW or VXC, but also includes a 3% allocation to Canadian stocks. Keep in mind that VT is only more tax efficient in an RSP or RIF account. VXC or XAW would be better choices for TFSA, RDSP, RESP, or taxable accounts. Next up, let's take on currency hedged global bond ETFs. These are also subject to foreign withholding taxes on the coupon interest paid to foreign investors. The most common ETF structure for this asset class is a Canadian-listed ETF that holds a U.S.-listed ETF that holds the global bonds. Although global bonds have not yet caught on with Canadian ETF investors, it's still worth mentioning them, as many of the popular asset allocation ETFs include them. For example, the Vanguard U.S. Aggregate Bond Index ETF, VBU, is a currency-hedged U.S. bond ETF that is included in all of Vanguard's asset allocation ETFs. VBU holds the Vanguard Total Bond Market ETF, BND, which is a U.S.-listed ETF that holds U.S. government and corporate bonds. Although most U.S. coupon interest is exempt from withholding tax, there is a small portion that is unrecoverable in all account types except taxable, where a foreign tax credit is available. At my last review, this tax drag is around 0.1% in registered and tax-free accounts. The Vanguard Global ex-US Aggregate Bond Index ETF, VBG, is another currency-hedged fixed income ETF, but it invests in global bonds outside of the U.S. VBG holds the Vanguard International Bond ETF, BNDX, which is a U.S.-listed ETF that holds global bonds, excluding U.S. bonds. Similar to international and emerging markets equities, coupon interest from VBG is subject to 2 layers of foreign withholding taxes, and the second layer from the U.S. to Canada is the most punitive. In RSPs and TFSAs, both layers of foreign withholding taxes are unrecoverable. So at my last review, the tax drag was around 0.35%. In taxable accounts, the second layer of U.S. withholding taxes may be recoverable, so the expected tax drag is closer to around 2 basis points. Perhaps as a result of this additional tax drag, BMO and iShares have opted to exclude currency-hedged global ex-US bonds from their asset allocation ETFs, while Vanguard has included them. Relative to Canadian bond ETFs, currency-hedged global bond ETFs have higher MERs. With that, and the additional foreign withholding tax drag, I tend to exclude both from my clients' portfolios, although that could change with future product improvements. Finally, we have one fund solutions, or asset allocation ETFs. The estimated tax drag for these ETFs would be similar to the weighted average tax drags of Canadian-listed global ex-Canada ETFs and currency-hedged global bond ETFs. That drag in RSPs and TFSAs ranges from around 0.13% for the most conservative asset allocation ETFs to around 0.25% for the most aggressive. And in taxable accounts, the unrecoverable withholding tax is expected to be minimal, at just around 1 to 2 basis points per year. The only way to reduce the foreign tax drag in your RSP account is by breaking up with your asset allocation ETF. This would increase the complexity of your portfolio, but it could reduce your annual cost by between 0.28% and 0.37%, depending on your asset mix. If you go this route, remember that you'll need to purchase some ETFs with US dollars, so you'll need to be comfortable with the Norbert's Gambit strategy. You'll also want to have a large enough portfolio to make the extra effort worthwhile. If you are interested in increasing your portfolio complexity from light to ridiculous, I've posted model ETF portfolios on my blog that will help you reduce the foreign withholding tax drag in your RSP. We're nearing the end of the show, but we still have time for a listener question. This next one comes from Martin regarding BlackRock Canada's new US dollar foreign equity ETFs.
Hi Justin, I recently learned iShares has released US dollar versions of XUU, XEF, XEC, and XAW, with ticker symbols ending in .U. I was wondering if these new funds will be subject to foreign withholding tax when held in an RSP. I'm also wondering if they can be used for Norbert's Gambit. Thanks for all your work and Happy New Year.
Happy New Year, Martin. Great questions. Unfortunately, XUU.U, XEF.U, XEC.U, and XAW.U are still Canadian-listed ETFs, so they'll have similar foreign withholding tax implications as their Canadian dollar counterparts when held in an RSP. Remember, it's the fund structure, such as Canadian-listed versus US-listed, not the trading currency of the fund, that determines the foreign withholding tax implications. As well, the Canadian dollar and US dollar versions of these funds cannot be used to implement the Norbert's Gambit strategy in your RSP. This is because BlackRock Canada set them up as separate securities with different CUSIP numbers. CUSIP stands for the Committee on Uniform Securities Identification Procedures. If they had the same CUSIP numbers, you could use them interchangeably. This is the case for DLR and DLR.U, which is why investors can use these two securities to implement Norbert's Gambit. It's a shame BlackRock Canada didn't create these securities to have the same CUSIPs. If they had, investors could buy XAW with their Canadian dollars in their Canadian dollar RSP, transfer it to their US dollar RSP, sell XAW.U, and then purchase a US-listed global equity ETF like VT. This would allow them to maintain similar market exposure during the process, as well as reduce the foreign withholding tax drag going forward. This would also avoid the market timing issues I discussed with Rob Angan on episode 1 of the podcast. The only advantage I see for these .U series is that they're able to get around CRA's T1135 reporting in a taxable account. That is, if you already hold US dollars in your taxable account and don't want to convert them to Canadian dollars in order to purchase Canadian-listed foreign equity ETFs. But you would have to calculate your cost base in Canadian dollars and adjust it each year for any return of capital and reinvested distributions received in US dollars, which is going to be a hassle. Hope this helps. In the next CPM podcast, we'll discuss asset location strategies. So if you like thinking about your foreign withholding taxes, you're going to love diving into optimal asset location to go with it. See you then.